War hit the tape, and the metals market reacted like it always does when missiles start flying. It stopped being a spreadsheet and started being a reflex. Gold pushed into the $5,600 zone on the headlines. And the question everyone is holding their breath for is simple. When futures reopen after the weekend, does silver gap, or does it whip everybody first? I'm not here to hype you up. I'm here to keep you sharp. Welcome back. This is your no-fluff market breakdown. Let's get into it. First, the situation. The Middle East headlines accelerated fast, the kind of fast where social media turns into a blender. Real reporting, old footage, recycled clips, dramatic captions, confirmed posts that aren't confirmed at all. So we're going to run this the right way. What looks real, what's just circulating, and what the market typically does when fear meets thin liquidity. Because the biggest mistake in weekends like this is marrying the first candle. Saturday in New York, markets closed, emotions open. And that's exactly why this moment is dangerous. The countdowns, the dramatic music, the buckle-up energy, none of that helps you make better decisions. It activates your nervous system, and then you trade just to calm your body down. Don't do that. If you remember one thing tonight, remember this. The market will still be there after the first rush of adrenaline. Your capital should still be there too. Now, what appears to have happened? Multiple reports indicate a major strike involving the US and Israel against Iran, followed by retaliation that reached Israel and locations across the Gulf region. Whether every detail is perfect in the first hour is not the point. The point is the market heard escalation, and it priced risk immediately. That's the reflex. People dump what feels fragile. They buy what feels durable. They hedge what they can't control. And everyone else tries to separate information from panic. Here's the first key. Gold and silver don't behave the same in a shock. Gold is usually the seatbelt. Silver is usually the roller coaster. Gold tends to move like a reserve asset. Silver tends to move like a reserve asset, and an industrial commodity, and a leveraged trading vehicle, all at the same time. That split personality is why silver can look like a genius trade at 8:02 p.m. and a trap at 8:17 p.m. So when someone tells you silver will definitely gap higher, what they really mean is silver will definitely be dramatic. And dramatic does not always mean up. Let's talk about the reopen timeline, because this is where people get chopped to pieces. In the US, futures reopen Sunday evening. That first hour is often thin, jumpy, and headline-driven. Then Asia comes online, and you get a second wave of price discovery. Then Europe. Then Monday morning cash markets. So you can easily get a Sunday open that says one thing, an Asia session that says another, and a Monday that rewrites the whole story. That's not chaos. That's how price discovery works when liquidity arrives in layers. Weekend trading is like trying to judge the health of a city by walking through its airport at midnight. The lights are on, people are moving, but it's not the full picture. Some of the biggest participants aren't active yet, and the participants who are active are reacting to headlines, not building careful positions. So if the first move is violent, it might be real information, or it might be a thin hallway where one person running makes everyone else run. Now let's address the biggest domino everyone keeps mentioning: energy. The Strait of Hormuz is not a meme. It's one of the most critical oil choke points on Earth, and even the possibility of disruption forces an immediate risk premium into crude. A huge share of global petroleum liquids flows through that corridor. So if shipping even hesitates, the oil market doesn't wait for a signed memo. It reprices immediately. And when oil reprices, everything else hears it. Shipping costs, freight rates, industrial input costs, inflation expectations. And inflation expectations are one of the invisible levers that feed straight into gold. While everyone is staring at missile clips, bond traders are quietly adjusting what they think inflation might do next. That's where the second headline lives. Here's the pattern that repeats in these moments. Shock hits, oil spikes, markets freeze for a second. Then they decide. Either the supply chain impact becomes real and the move extends, or the fear premium bleeds out and the market snaps back into its bigger trend. And the decision can happen fast. We've already seen reports of air travel disruptions and cancellations around the region. That matters more than people think, because logistics is the bloodstream of the global economy. Now another underrated pressure point: insurance. Insurance is the plumbing of global trade. You don't think about it until it stops working. In conflict zones, war risk insurers can cancel coverage, reprice coverage, or make coverage so expensive that ships hesitate. And when ships hesitate, supply chains don't need an official closure to slow down. They just need friction, more cost, more delay, more uncertainty. That feeds into commodity pricing, including metals, because metals are not only money, they're also physical goods that have to move. Now let's deal with the fog. In fast conflicts, you will see a flood of clips. Some are real, some are old, some are real but miscaptioned, some are edited. So don't be cynical and say everything is fake. Be skeptical and say, I'm not buying this until it clears a basic filter. Here's the filter: location, timestamp, second source. If none of those exist, treat it like raw material on a conveyor belt at the beginning of the factory. It hasn't been inspected yet. Don't build a life decision on it. But also don't ignore the market's behavior, because the market isn't waiting for your comfort. It prices risk before you feel ready. And that brings us back to the question everybody wants answered. Will silver gap higher tomorrow? Yes, it can. But gap is not magic. A gap is simply price discovering itself after a pause, often in thin liquidity, often under emotional pressure. And the first gap is frequently the overreaction. The second move is frequently the truth. So the real question is not, does it gap? The real question is, does it hold? What would have to happen for a gap higher to hold? You'd need escalation that looks durable, not just noisy. You'd need crude to stay bid, not just spike. You'd need insurance and shipping stress to persist, not just get priced for 30 minutes. And you'd need broader risk markets to stay shaky, because if stocks rip higher, silver can get pulled in two directions at once: safe haven versus industrial demand. That tug of war is where traders get destroyed. Here's the trap, and I need you to see it before it happens. The Sunday Open can gap up, and the chat will scream, "It's happening." Then liquidity arrives, spreads widen, and the market hunts stops. It can dump first, just to shake out the weak hands, and then rip higher once the late sellers are gone. That's silver. It doesn't just move, it tests you. So if you have no plan, the market will write one for you. Now let's talk about the tokenized gold angle, because it's becoming a big part of how people read crisis demand. When you see a token like PAXG trading hot during a weekend, it can mean real demand. Or it can mean venue liquidity and crowd behavior. Think of it like an airport gate. The plane didn't suddenly become more valuable. The crowd got bigger, and the cost of getting through the crowd went up. So if someone flashes you an extreme print and declares, "This is the real gold price," you need to ask 3 questions: where, when, and under what liquidity conditions. Comment question for you. Do you think tokenized gold reflects true crisis demand, or is it mostly a liquidity and venue effect when fear spikes? Now, there were also claims circulating about leadership casualties and dramatic turning points. If those reports hold, that's not just a headline. It's an escalation marker that can change alliances, internal dynamics, and conflict duration. But the first hours of breaking news are messy. Even major outlets can get details wrong early, not out of malice, but out of speed. So treat the early hours like a draft. Watch for confirmations, walkbacks, and second-order effects. And in this story, the biggest second-order effects are not the loud clips. They're the boring mechanics: energy routes, shipping costs, insurance, and confidence. Confidence is the real currency in a crisis. Now zoom out. Gold has a different backdrop than most people realize. Over recent years, central banks have been persistent net buyers of gold. That creates a different floor under the market. Retail panic comes and goes. Paper positioning whips around, but steady large buyers change the regime. Add geopolitical shock on top of that, and you don't need a conspiracy for gold to stay supported. You just need uncertainty plus buyers who don't care about your Monday chart. Now let's talk about why silver is the harder hold. Silver has the safe haven story, but it also has the growth story. When fear spikes, silver can run with gold. When the dust settles, silver can snap back to trading like an industrial metal. So you can get a world where gold holds steady and silver whips like a kite in a storm. That doesn't kill the thesis, it just tests your discipline. And discipline is everything in a market like this. Because here's the ugly scenario nobody wants to talk about. Sometimes the crisis headline makes everything sell. Not because the crisis is bullish or bearish, because margin calls hit. Funds need cash. They sell what they can, not what they want. That's how you can see gold dip briefly even when the world is on fire. Not because gold failed, because liquidity demanded sacrifices. If we see a strange move where metals dip right after an ugly headline, don't assume the story is over. Sometimes that dip is the forced sale before the longer move resumes. Now let's get practical. If you want to know whether stress is real, stop staring only at spot. Spot is a quote. Stress shows up first in friction. Premiums, inventory notices, checkout freezes, delivery windows stretching. Dealers don't pause orders because the world ended. They pause orders because volatility breaks hedging, and they can't replace product at the price they're quoting you. So if you see online carts temporarily unavailable, or dealers widening spreads, that's not a conspiracy. That's the market admitting it's uncertain. And uncertainty is bullish for the concept of gold, but chaotic for the execution of trades. A lot of people are asking the same questions right now, and I want to answer them without the live stream noise. 1. Should I own miners or metal? Miners are leverage. They can outperform the metal in strong trends, but they are businesses. They have costs, jurisdictions, politics, dilution, management, and equity market mood. In a geopolitical shock, miners don't always behave like the metal. If you want crisis protection, understand the difference between an equity and a bar. 2. When do I swap silver into gold using the gold to silver ratio? Everyone wants a magic number. There is no magic number. The ratio is a tool, not a prophecy. If your goal is to end up with more gold over time, you plan swaps in advance, scale them, and don't let your emotions pick the day. And here's the honest question. Will you actually swap when silver is euphoric and everyone is screaming higher? Because that's when the swap feels hardest. 3. Is junk or constitutional silver worth it? It depends on purpose. If you want small denomination recognizability for emergency scenarios, it can make sense. If you want maximum ounces per dollar, premiums can be brutal, especially in panic windows. Don't buy it because it sounds heroic. Buy it because it fits your plan. 4. How do I handle storage and safety? This is the boring part nobody likes, which means it's the part most people ignore until it's too late. If you're holding meaningful value, think through storage, documentation, and insurance options. Each option has trade-offs: access, privacy, cost, counterparty risk. But doing nothing is also a choice, and it's usually the most expensive choice in a crisis. Now let me ask you the second comment question. Do you think this conflict stays contained, or do you think it spreads? And don't just say yes or no. Tell me what your signal is. What headline, what action, what move in oil or shipping tells you, okay, this is widening. Now one more layer that often gets missed: cyber risk and domestic threat posture. When tensions rise, agencies often remind the public to stay aware, report suspicious activity, and be mindful of cyber disruption. Why does that matter to markets? Because cyber incidents can hit banks, pipelines, logistics, payment processors, and media systems. Even small disruption can create outsized confidence shock. And again, confidence is the real currency in a crisis. One more thing, because this is where the pros quietly win. There's a three-wave headline cycle in events like this. Wave 1 is the shock. Everybody reacts to the first breaking banner. Wave 2 is the, wait, was that clip old? Phase, when rumor and reality get sorted and price snaps back and forth. Wave 3 is the boring phase, and it's the most important. Insurance renewals, rerouted shipping, freight surcharges, emergency meetings, policy statements, and what oil does once the first adrenaline candle closes. Most people trade Wave 1. Professionals position for Wave 3. So if you feel the urge to do something immediately, pause and ask yourself, am I reacting to Wave 1 or am I preparing for Wave 3? Because the market's next real message might not arrive at the open. It might arrive an hour later, when Asia confirms or rejects the first print. Now bring it all together. Markets hate uncertainty more than they hate bad news. Bad news is a number. It can be priced. Uncertainty is a cloud. It forces hedging. And in that cloud, gold tends to act like an anchor. Silver tends to act like a kite. Sometimes it lifts. Sometimes it snaps. If you aren't prepared for the snap, you will do the worst thing: buy high, sell low, and then claim you believe while your actions prove you're reacting. So here is a clean mindset for the next 24 hours. Don't let the first headline make your decision for you. Don't stare at the first candle like it contains truth. If you're already positioned, stop checking the chart every 5 minutes. If you're not positioned, don't chase the first spike without a plan. And watch the real transmission channels: oil, shipping, insurance, and physical premiums. Because premiums are often the truth paper tries to hide. Now, I want to say something directly to the adrenaline crowd. You don't need the world to burn for silver to do well. You don't need catastrophe to justify a metals thesis. Rooting for disaster is the fastest way to lose your perspective. What we want is functioning markets that reprice reality. Because if the system breaks hard enough, you don't get infinite upside. You get rules. You get restrictions. You get paperwork. You get capital controls. That's not a win. So play the grown-up game. Build resilience. Hold quality assets. Stay liquid enough that you are not forced to sell. Let long-term trends do the heavy lifting. And those long-term trends haven't vanished. Fragile supply chains, persistent deficits, deglobalization pressure, and steady reserve accumulation. Now here is the cliffhanger you need to keep in your head. If we wake up to a huge move, the real question is not, how high did it go? The real question is, did it stay there when real liquidity arrived? That is the tell. That is how you separate a headline spike from a regime shift. So going into the reopen, keep this checklist. If you buy physical, understand premiums and delivery delays. If you trade paper, respect liquidity and volatility, especially on the first reopen. If you're long-term, zoom out and breathe. If you're brand new, start small and stay humble. And yes, if you want the fastest way to stay ahead of these moves, subscribe. Short, simple, done. Because the market won't warn you before it reprices. I'll be monitoring the first reopen, then the Asia handoff, because those two windows can tell completely different stories. And when the market finally speaks again, the question won't be whether it moved. The question will be whether it revealed stress or just emotion. Stay sharp.